Hello, everybody. Welcome in. It's Sunday, and this is the biggest Q&A ever. So thank you all for coming, and shout out to Team Canada. I have a mug from every part of the world, and I showcase where the people are most passionate every single time. So thank you all for joining. Again, as I said, this is the biggest Q&A ever. Rusty bought up there in Norway. People from all over the world. It's so cool. Australia is waking up. We might get a couple coming in early. Again, this Q&A will cover a 50 bagger, and you'll figure that out later, and also 60 nuggets. So thank you all for coming. And none of this is financial advice, but what it is all the stuff that I do and how I think and how I've been able to kind of outsmart the markets. So, and all the questions come from Patreon. Huge thank you to everyone on Patreon. But it's getting pretty hectic now with the type of questions. And for the first time ever, we're going to be touching on a whole bunch of equities as well as some crypto stuff. And I want to try and please everybody. So there's just more and more questions will be answered. Let's go. Let's start at the beginning with Mr. Scrooge. And sometimes I get these personal questions and they have to make me think. But if you could go back in time and tell yourself 3 hints on your first day of trading, what would you say and why? Well, I think about this all the time. You know, if I could turn back time, what would I do? But sometimes kind of slow and steady is a good strategy. But the 3 things that I would tell myself, again, because when I was in my 20s, I was extremely impatient. And, you know, don't expect overnight success. Be patient. It does take time and effort to achieve your goals. And also, don't give up. Never give up. I'll never give up no matter what happens if you don't see results immediately. That's the first thing. Patience, patience, patience. And I always talk about patience. Second, which goes a little bit counter to patience, is be more aggressive. After, you know, when I was young, I was both very impatient, but not aggressive enough. And what I mean by that is kind of don't be afraid to take risks and go after what you want. Don't let fear hold you back. I should have done things earlier in life that I didn't do because I was conservative. And I thought it'd be safer to stay and say one job or whatever, or not put certain amounts of money in certain things. And I see you out there, Z and Kyle. You're very, very gracious. And the third thing was I discovered during this bear, well, I always built models. I'm a model builder. And I used to try and build them in the 90s, but the tools weren't available to build models like Python, etc., to be able to do things like backtest at scale, etc. Now we can, but I still believe I could have built a lot more models earlier and not wait, because they are game changers. And we might talk about a couple of those later as well. They're the 3 hints: more patient, more aggressive, and do more models. Leverage the models as much as possible. They change the game. So next question from Cyborg. Been using IADSS to identify buy alerts for stocks, then I nibble in a rollover IRA account. Good for you. Hoping for a dip so I can buy larger amounts. Should I also be using DCAS? Looking to build my 80% HODL bag and 20% trading bag, remember? P.S. Hard to find time to learn options. Well, we're getting more and more options questions. We have one coming, actually 2 coming up in quick order. But first of all, this is from a member using DCAS. Shout out to W. This was posted on Discourse 2 days ago. But basically, they were amazed at the DCAS, which is dollar cost averaging on steroids, how, you know, starting at the top of the bull market, you'd still be in profit using DCAS of about $1,300. And this is a very small DCA amount versus if you just did DCA, you would actually be in a loss. Also, you would have accumulated a lot more Bitcoin, 0.55 versus 0.34. So the model crushes it even in bear markets. So that's the thing about DCAS. Now, if you have IADSS and you see a Pico moment, we'll talk about one of those shortly with Meta and how it identified that. You know, things that just happen once every 2 or 3 years, or sometimes even every 10 years. That can really help you pinpoint when to just dump everything in, because lump sum at a bottom, nothing beats that. So if you can buy Meta at $90 versus DCAing in as it goes to 300, obviously buying it all at $90 is the better way to go. Now, what DCA on steroids does tell you is 3 things that are kind of critical: when to buy, when not to buy, and how much to buy, the load that you buy of your DCA amount. But again, lump sum beats it if you can nail the bottoms, and that's critical here. So what I like to do is a combination of both as well. Use IADSS to identify when things are extraordinarily out of sync, cheap, oversold, whatever you want to call it, and then use this as well to identify the loads and how much to double in, and also the layer model to identify exactly, first tranche is say a 1x, say $100, second tranche $300, third tranche $900. I get that question a lot as well. So hope that helps. Now I will be going fast because we have like 16 questions to answer. So remember, if you need to watch this segment twice, we'll have timestamps for everything later so you can go into the pieces that you're most interested in. So this is from 3 people. Now everybody's concerned about, is the Bitcoin ETF from BlackRock going to kill MicroStrategy? Basically the crux of it. From Dr. Pauf, it's Prime Time, and Peter S. So this is interesting. What percentage of MicroStrategy is owned by large players? First question. What impact will the approved Bitcoin spot ETF have on the current shareholdings? And why won't it negatively impact MicroStrategy value over the long time? When it arrives, is it game over for the MicroStrategy proxy? Presumably, investors would prefer the pure form of Bitcoin ETF. Whew, what's that, 5 questions in one? I'll tackle them all one by one. This is the MicroStrategy ownership today. Michael Saylor has the biggest bag, 14.25%. Then you have all the usual suspects are in there: Vanguard, BlackRock, State Street, Morgan Stanley, Citadel, you name it, all over the place. And they all have big chunks. But remember, they also buy because they have to kind of allocate accordingly to indices like Russell 2000, etc. So they have to be in the position. But also you can see BlackRock buying up a ton of proxies and a ton of miners right now as well, way beyond what their index should be. Next, let's talk about what the difference in ETF and MicroStrategy and why I like MicroStrategy. I always call it financial jiu-jitsu. That's what MicroStrategy can do. So MicroStrategy uses free cash flow from their software business to buy Bitcoin. They issue stock to buy Bitcoin. In fact, they just issued $750 million since the 30th of July, by my calculations, to buy Bitcoin. We will find out what they bought, I'd say, real soon. Also, MicroStrategy issues convertible debt to buy Bitcoin, and MicroStrategy can borrow against their Bitcoin and buy Bitcoin. None of these things can be done by an ETF. That's the difference. In addition, what makes these are actually Michael Saylor's exact words. Why MicroStrategy is better than a spot ETF. If there was a spot ETF, you'd be paying a 1% fee. Fees, of course, can vary. Grayscale's 2%. Maybe a big scale ETF could be half of 1%, but somewhere 1%. Also, with MicroStrategy, you have a software company that generates cash flow. I covered that in the previous slide. They can convert our cash flow into Bitcoin. And third, MicroStrategy is a de facto Bitcoin spot ETF that generates a 4 to 5% tax-deferred yield. A lot of people might ask, what is that? Well, the yield from MicroStrategy's Bitcoin holdings is tax-deferred, which means that investors do not have to pay taxes on the profits until they sell their shares in the company. Ta-da! That is actually very, very important. So, they could have a whole bunch of realized or unrealized gains on Bitcoin, but you don't have to pay tax on that. But you do see it reflected in the stock. In addition, so basically, in answer to the question, I do not believe that the spot ETF from BlackRock and all the other players will kill MicroStrategy or miners. It'll just be another option, and I'll just bring a lot more money to the space and everything else will go up. Now, the next question is kind of related to this as well. This is from Josh R. What is your favorite pair trade? Is there one you keep coming back to? Yes. This is what I call a softball, easy ball, gimme ball or something. So my favorite pair trade is, of course, Bitcoin and MicroStrategy. And it's so much my favorite trade. I've been doing it ever since MicroStrategy started buying Bitcoin. I saw the option for the ARB. ARB is part of my background. And I actually created a model called the ARB Cloud that does exactly this. And this is what I call the gift that keeps on giving. So I have very, very large positions. Sometimes I swap those positions into Bitcoin and back into MicroStrategy. I do this on Robinhood, in full disclosure. And also, I do it using equities and options too in other brokerage accounts as well. There's many ways in which I play this. So next question. This is from Abdurrahman. You have done many face-off crypto videos, and as per data, Sol won in all projects. My question is, when will you be shifting your portfolio from ETH to Sol and add a bag of the Sol killer? So this is kind of interesting, and this goes back to a lot of what we'll discuss today is kind of risk reward. What is the safe bet versus the kind of YOLO bet? And I always allocate accordingly. But let's look at the quick face-off summary. I just ran these numbers. We now have a model that can pump this out real fast, which is pretty cool. But if you look at these first areas, Nakamoto, block time, finality, max TPS, daily transactions, daily users, DTX over DAU, average fee, developer, circulating supply, you can see Solana wins 6-4. Okay. In the second part, ETH wins 6-4. So you could call it a tie across FDMC over daily transactions, FDMC over daily active users, FDMC over developers, FDMC over TVL, DEX volume, stablecoin, distance from all-time high, fully diluted market cap as a percentage of ETH, etc. Twitter followers. So Twitter followers isn't really important, but you can see that despite the fact that Ethereum has been around 7 years longer than Solana, it doesn't have that many more Twitter followers, which is fascinating. But the real difference is how much better, and I'm getting to the point in a second, how much better, by what magnitude, is Solana. And if you look here, red is Solana and the deltas, and then blue is ETH. You can see it smashes it. Now, these things are on a log scale on the left, and that is the big difference. So the chain, looking at all of the key factors, they have, 10 wins each. But in reality, where Solana wins, it wins by a lot more. Where Ethereum wins, it only wins by a fraction. So that's why now, getting back to your point, there is still risk until Solana comes out of beta, until Solana comes out of kind of the FUD factory. I'm not ready to deploy, but I have enough. In fact, this recent dip, I didn't buy because my allocations are where I need them to be right now. So I hope that answers your question. Remember, risk reward, Ethereum is safe. It's established. It's been around for a long time. The risk is very low. When big money comes in, they'll go into ETH first. Although we have seen so far this year in 2023, institutional money is going into Solana more so than Ethereum. So who knows? We'll watch that carefully, and I cover that in Octa every Tuesday as well. This is the magic question, though. When you break it all down, is Ethereum 20 times better than Solana? And the answer, in my opinion, is no. But there is risk with Solana. Therefore, you allocate accordingly. Not have 1/20th, but my bag size is about ETH dollar value right now is about a third the size of my Solana bag is about a third the size of my ETH bag. But it will grow, and I think it'll grow faster. But that little skinny green slither on the right is the market cap of Solana versus the market cap of ETH, and it is. The ETH market cap is 20 times higher, which is stunning. And I look as an investor for relative value. Solana is a screaming buy at this price, but we'll just wait and see where we get to as we go forward. And nobody will be watching as closely as me. Next question is from Crypto Cephalon. The end of the first Polkadot parachain lease period is approaching. This means a substantial amount of DOT that has been locked in for 96 weeks, which is nearly 2 years, will be released. What implications might this have for the price of DOT? Well, this is a tricky one to guess exactly what will happen. So there's 3 scenarios, but first of all, there's a positive scenario. That is, there's a high demand for the parachain slots after they release, and substantial DOT bonding may drive up DOT prices. Bonded DOT remains locked, reducing available supply, while strong parachain interest indicates a thriving Polkadot ecosystem, boosting Polkadot value. Okay, that's the positive scene. Negative scenario is low parachain demand, insufficient DOT bonding, may lead to DOT price decline. Unbonded DOT earns no rewards and is effectively removed from circulation. And lack of parachain interest could harm DOT's value. And neutral, you got balanced demand and DOT having a neutral impact on DOT prices. Supply and demand remain stable, resulting in minimal price fluctuations. So that's kind of where we are. What I'm seeing, though, is Polkadot has been one of those things where there's tons of development happening, but it's not really getting adopted, which is kind of scary. So this is, again, another kind of example of a face-off of Polkadot. They have an amazing Nakamoto coefficient of 70, but everything else falls flat against something like Solana. So my question is, why risk it? And the other point that we'll talk about many times today is I'm extremely picky about my assets. I'll blow this little picture up of little James here. Very fussy about what he eats, what he buys, how he invests money. So my whole point of view, you've heard me say 98% of crypto is a scam. So I focus on the 2%, the winning 2%. Same thing with equities. You can take that same 2% roll or 1.4% roll, whatever you want to take. We'll just round up to 2%. 7 of the top 500 companies in the US drove all the results this year, the Magnificent 7. That's 1.4% of the S&P 500. Be in the 2%, ignore the 98%, and that's going to be a key lesson as well as we go forward today as well. Adam Q, thank you. Let's go. Next question is from Nick Naylor. Finally, I have enough 100 plus Tesla shares to start dabbling with covered calls, and I've been going through your options playlist. You usually sell calls that are 6 to 8 weeks out. Can you explain the timing and the mechanism of rolling up the call if the stock price keeps going up? And when do you roll up? And do you keep the same expiry date? So, first of all, there's multiple complex pieces in that. 6 to 8 weeks. Why I choose that time frame is that little green box on the right. You can see that's when max theta decay happens. This time decay. That's when all the time value that you sell shrivels up to nothing. We saw that very recently in all the posts I made about the covered call strategy and MicroStrategy and how, you know, something went from $60 to zero in literally about 3 weeks. It was mad to see. But the other things that I also think about when I sell calls, first of all, on Tesla is my 8-year play, like we're going out to 2030. Unless something significantly changes to the company. This is something I don't want to get called out of. And I will only sell calls on gamma squeezes, which I've covered as well in Patreon. Now, it's just too precious. I don't want to lose it. I also believe we're going to 350 to 400 before considering a call. And also, I find it easier to sell a lot of calls against MicroStrategy and miners and help embellish those positions. So just be very careful because you just don't know what's going to happen. Now, that being said, regarding Tesla, they had the most amazing news 9 days ago that should have broken the internet, but no analysts, nobody on Wall Street is talking about it. Okay, so that's the ability for AI to be fed videos and generate, you know, intelligence to drive a car by itself. That is the biggest watershed moment of my entire life. That the only people that are talking about it are people that understand how profound it is. But Wall Street has no clue what it means. So again, it's not reacting to any of the incredible news. Model 3. What car on earth can even come close to the new Model 3? The answer is nothing. Anyway, that's just markets are irrational. And they can stay irrational longer than you can stay liquid. So another lesson today. Let's go from Sirius. And this is a serious question, excuse the pun, from Sirius. I have 10,000 ready to invest. I want a 20x to 40x alpha opportunity for the next 24 months. Looking at Sol and or Tesla calls out of the money, way out of the money, actually, a $390 strike. It appears there will be a great move up in the equity market in the coming months. In the meantime, Sol may be moving down a little. Can I park my fund in Tesla for 3 months, grow my base, and then move to Sol by December, be able to acquire more Sol? What would you do? Well, first of all, you showed a very far out of the money call option, okay? And you'd be selling time for 3 months and then getting out of that position. Remember this chart? You're selling time, it decays. You're going to have less money unless, of course, Tesla goes on a rampage in the next 3 months. And that's something that you can't count on. Second of all, I know where you're getting the, I want to make 20 to 40x. It's easy because you see me do it. Yes, in fact, this meta trade alert from Patreon from October 27th is now a 50.5 bagger. It's a 50.5x, a 4,950% return on investment. Cost per share was $4. Now the position is worth $202. So I understand that, yes, 40x's are possible, but they are very risky to do. and they only happen, very, very seldom time. Now this was a very small position that became a very large position, and I'm waiting for long-term capital gains to exit. So I've got to wait 7 more weeks. And then this trade should pay for 5 years of mortgages for me. Mortgages, plural. That's how big a little amount can become. So I see what you're saying, but remember, this was the bottom of a bear market. Perfect timing, perfect precision. 20x's and 40x's are super rare, and very few people actually make them. You need a special strategy to do this. See the exclusive Patreon videos on how I did it. Also, going in with these expectations is setting yourself up for failure. So don't do that. Don't think 20x is easy in the markets. Second, never buy short-term options or out-of-the-money options. Huge chances you will lose. So that's kind of like a hard-hitting news. Don't lose faith. But if $10,000 is your entire bag, be very careful with it, because you can blow it up if you make one mistake. So do covered calls, pair trade crypto. Remember, I'll say it again, 40x is unrealistic. It is possible. I've done it many times, but it is rare, and you can only do it at extreme market bottoms. And again, precision and timing is absolutely critical. But going in there saying, I want to take 10,000 and 40 exit is just setting yourself up for failure. Okay. My job is to be very straight and honest, and I know that might be disappointing to some. There's many people that go into crypto thinking, oh, I'm going to 100x my money. I'm going to take $1,000, I'll have $100,000 in 4 weeks. That's not the way it works. Remember, 98% of crypto will take your money. It will not give you money. So sorry for all the hard lessons today, but that's my job. Daniel K., your thoughts on the potential of the stock Broadcom, ticker AVGO. It used to be BRCM. I used to trade it way back in late 90s, early 2000s. But they do have some good acquisitions under their belt, and the price of the stocks performs decently over the years. Is it a buy in small amounts, and what are some good levels? NFA from Daniel K. So let's look at this carefully. There has been some of the AI hype is very real, like NVIDIA, like Tesla. But then what happens is that hype sucks in a lot of other players where they don't quite have the same level of reality, and they get overbought. So let's look at a chart here for AVGO. And IADSS did flash a sale at $8.50, and it fell $50 on Friday. These are the layers from the layer out model, and it shot up nearly to layer 10, which means it's redlining. That means it's got to mean revert and come back. So I would not touch Broadcom at these levels. I'd like to see it at least down around level 7 or the 200-day moving average. Now, the problem is they did kind of earnings really disappointed the other day. And when you look at the financials, there's a couple of things that concern me. Just a quick summary of financials. Yes, it's growing. Yes, it has good margins. But somehow the text is missing behind the debt is scaring the life out of me. That is the red on the right compared to the cash position. They have like 40 billion in debt versus EBITDA of only kind of 17 billion. So there's way too much debt for my liking right now. I prefer companies, especially with high interest rates and everything else, less debt. But they are growing. They are doing well. I just think they got a little bit overheated. Plus, I think the fair value right now for AVGO is about 650, not 850. So hope that helps. I think, again, as I mentioned before, I'm very picky about my assets, and I think there's safer bets out there. You may not get the same hype machine that you do with Broadcom, but in time they will really pay off. So next question is from Tommy. If there is an 85% chance of recession and job losses for next year, wouldn't that mean crash for real estate as well, as since people are losing their jobs and can't pay the 7% rates with high housing prices? Tommy, this is a brilliant question. And again, this is not only it's a alpha packed Q&A, but it also has some sad news. So first of all, U.S. home ownership, you're dead right, but it's already happening what you're talking about. So this chart says it all. Sad news, Tommy. As I said, it's already happening. According to a recent report by the US Census Bureau, 41% of homes are owned by somebody who does not live there. These are investors. These are people who rent out their homes. And that means that over 40 million homes in the United States are not occupied by their owners. This is a significant decline from the 65% home ownership rate that we had in the year 2007. And since the rate hikes, you can see what the rate hikes have done to home ownership in the US. Since 2022, home ownership has gone from about 63% down to right now, it is around 59%. That may sound like a small percentage change, but that is millions of homes. That's millions of people that aren't able to own a house anymore. And that means it's being sold to somebody who buys it and then rents it out. And you know how much I've always stressed the importance of having your own castle. This is bad and this is ugly. And what's happening is, like with many things, the money is bubbling up to the wealthier people. The wealthier people are dominating the home buying right now. And you can see this with this, the red is kind of the low priced homes, kind of less than $300,000. They've kind of dwindled away over the last 2 years. So not a lot of action there, but the big money, not only have houses still gone up in value, but they're being bought for a heavier price by people who are wealthier. And nearly 60% are $400,000 homes, and nearly 50% are worth more than $500,000. And with mortgage rates at 7%, there's not many people that can pay a 7% mortgage on $400,000 in debt if they put $100,000 down, or it's even a challenge to get that down payment of $100,000 to make the down payment in the first place. So, Tommy, you're dead right there. Next, this is from Papa Joe's. Can you share with us your thoughts on VFS, the Vietnamese EV automaker share has shot up wildly, and now it's almost 1/3 of Tesla's market cap. Good short opportunity? Yes. Yes, it was. Let's talk. The VFS is Vinfast out of Vietnam, and it became the third most valuable car company in a matter of almost hours. It's kind of stupid. Talk about a pump and dump. Not only does it happen in crypto, it happens in equities too. So this is the Vinfast pump and dump chart, and you can see, as of end of July, it was trading at around $8, $9, and they shot up to $95 plus. And after it shot up, it fell 70% in 4 days. So I wish you had brought this to my attention, because I didn't even look at it. I ignore kind of noise in the markets, but this would have been a beautiful short opportunity. Short that puppy at 95, ride it all the way down to, where's it at now? 29. It would have been so sweet. And again, the models also flashed a bunch of sales too. So the importance of models. Let's look at the financials for Vinfast as well to show you how bad it is. It's a complete turd. First of all, the shares are ridiculously volatile over the last 2 weeks. It has less than 1 year of cash runway left. It has negative shareholders' equity. Revenue fell 18% year over year, which is, how can this be a high growth company when it's shrinking? And if you look at the actual EBITDA, it is very, very negative. Net income is horrific. It's nasty. And look at the amount of debt to cash that they have. Again, nasty, nasty, nasty. There's nothing good about Vinfast. I just wonder who pumped it in the first place. Maybe it was like one of those meme coins or something, or just kind of the EV revolution. And this goes back to kind of the AI hype and BEV hype. There will only be one black hole that wins the whole space in both spaces, not 50 different companies. So remember that as well. Next question is from a nice guy. I like nice guys. I'm selling one leg of my three-legged stool, which is a nice guy's castle, to invest in my new business in Australia. Good on you, mate, as they say. My plan is to deploy the remainder into 1 Bitcoin, 100 Tesla, and 500 Solana. I'm tempted to deploy this quick succession before end of September. Could I get your NFA on this? Yes. So my non-financial advice is yes. September is a great time to buy because October is normally Uptober. Yes, there was one bad October, I can't even remember the year, a long time ago, but normally Rectember is September, and then things rebound really well. So your timing is impeccable, sir. And I like your mix as well. And good luck with the new business too. Hey, Jeff, good to see you, buddy. Next question is from Andrew S. Can you give us a breakdown of the fundamentals and future prospects for Salesforce? Appears to be trending nicely. Any thoughts? Worthy of a nibble NFA. So I know Salesforce extremely well. I've watched it over the decades. I know the DNA of the company. I know the people that run the company. I know where they came from. And they came from a company called Oracle. So I'm going to spend a second talking about Oracle, first of all. This is Oracle over the last 24 years. The key piece of the chart is cut off, but it doesn't matter. It's up 162% over the last 24 years. But the point is not that, but sometimes software that becomes old and stodgy stops growing as fast. So let's take the Oracle price divided by the M2 growth over the last 24 years. You would have actually lost money on Oracle. So there's enough time went on Oracle, but 24 years you've gone nowhere. Now, is SFDC Salesforce.com the new Oracle? A lot of the same management, a lot of the same people, a lot of the same, same product lines like CRM software, but this time sold in the cloud, and they were the leaders in the space. And so far, they did have a bumpy patch into 2022. They've had some problems at the Salesforce Tower in San Francisco. They'll probably have some exposure there. I haven't calculated exactly what that is, but you can see here, they still have solid revenue growth going up to a target of 43 billion by 2026 and earnings up to 6.5 billion. So they're still planning to make a lot of profit, and I still see earnings growth. But there's a few things that I don't like. And again, I want to show my little picture of me with apples. I'm very picky about stuff. So I do believe AI and AI startups will disrupt or at least eat some of the market share away from Salesforce. Customers need things to be better, cheaper, faster, and they have better ways now of empowering their own type of customer management. So there are a couple of new players popping up like Zoho, Pipedrive, and Cycly. These are kind of AI startups that work in the whole CRM space, customer relationship management space, and they could eat things. In addition, this might be controversial. Sit down if you're careful, but Mark Benioff, he is a great guy. He has founded 2 children's hospitals, done a lot of great work. He plants trees, and all of that is great. And I admire that, but he's very close to the World Economic Forum, who I do not like. Benioff actually is an agenda writer for the World Economic Forum, and he's very close to Klaus Schwab, and he's also co-invests with Bill Gates, and there's lots of connections there, and those connections I don't quite like. So I'd be on the fence about Salesforce, and I do believe, yes, it's growing, yes, it's doing well, but these are exponential times we live in, and therefore I believe it's time for exponential assets. I think Salesforce is coming towards the end of its kind of growth spurt. All the money was made between, say, 2013, 2015, and about 3 or 4 years ago. That's when you made the big returns on Salesforce. Those big returns are not going to return. You might get better returns than having something like Walmart or whatever, but again, exponential times, you need exponential assets. That means things like Bitcoin proxies and Tesla, those types of names, I believe, from all the work I've done. And I've done a lot of work in this area. Next question. Speaking of Bitcoin, this is from Gurpreet. By the way, if I'm going too fast or if these are too many questions, drop a comment, let me know. But the idea is to get to as many questions as possible because these are transformative times. The next 12 to 18 months are critical. That's what I'm trying to address everybody's issue. So this is from Gurpreet. Can I use the fund like BT, the short Bitcoin future fund, to hedge at a market top instead of selling my MicroStrategy share? If I book the profit, I may not be able to enter back due to the institution money breaking the 4-year cycle. I like the way you're thinking. Option selling is not available with my broker for US stocks. Bitcoin on-ramp difficult with higher crypto tax and equity in India, so all allocation in MicroStrategy. Target to accumulate 20K in Tesla. MicroStrategy sold before April 2024. Double the bag for India retirement cocktail video. Wow, you've done your homework, sir. You were very, very impressive. So first of all, let's talk about BT and BITO. BITO is the long futures option. BT is the short futures option. Remember, they lose 11% every 6 months. They lose it due to contango. And if you are investing in the futures market for Bitcoin, it means you will have contango and you have ETF fees that will eat your lunch. So this is just the contango effect of the loss on this future, 11.3%. So I don't recommend this. What you can do, you can actually do it, but you do not want to be holding one of these futures contracts for a period of longer than, say, 2 months, maybe max 3 months. Then you want to get out because they'll just shrivel away and melt away like an ice cube. So BT is that leverage ETF, which means, yes, returns are magnified, which you can hedge your position, and it can lead you to protecting your profits in MicroStrategy. But the contango is at least 0.5% per month, and then the fees are at least 0.95%, call it 1%. So you're going to lose between fees and contango 1.5%, and it's definitely not suitable for all investors. What I recommend you probably think about doing instead is buying a put option on a DEX against Bitcoin itself. But because you may need to hold that insurance for a 6 to 12 month period, and doing that on BT will eat you alive, my friend. So thank you for doing your homework, though. Great stuff. Next, from Prince Boyki. I have some Walmart stocks and debating whether to liquidate a sizable amount to buy Tesla stocks. I'm struggling with my decision because I'm not sure whether Walmart will be in 5 to whatever years from now compared to Tesla. Thoughts? Well, let's analyze Walmart first, and then we talk about exponentiality. So first of all, there's no real profit growth for Walmart. All right, it's basically going to flatline. There's also a revolution happening in the United States right now where people are wholesale boosting, shoplifting. Everything's free. You just walk into a store, fill up a cart, and steal everything. And retail stores aren't stopping them, and the laws do not stop them either in this country. So it's like a free-for-all, and retailers are getting hit hard. And I do expect this also to hit Walmart as we go forward. Now, let's look at Walmart like we did Oracle as another example. This is Walmart divided by MT money supply growth over the last 25 years. It's down 17%. You do not. Again, as I always say, you got to be in rapid growth stuff just to tread water. Keep your head above water. If you're not making 14% on your asset every year, you're not going to be able to make it, okay? This Walmart case of the last 25 years means you would have got stuffed just like you would have done so holding Oracle. You're not going to get anywhere holding these things for long periods of time. It is kind of sad. Now, let's talk about the comparison real quick. Walmart versus Tesla. Walmart is fairly valued. Okay, that means with no growth, it's going to trade at a very low multiple, and it's not going to go up in price. Despite the fact revenue is going up in price because of inflation, their earnings are not. Tesla is a different situation. They've got 8 different lines of revenue, all highly profitable, and they will start turning on that profit lines in 2024 with a whole bunch of stuff. I mentioned retail is suffering the boosting epidemic. Walmart EBITDA. By the way, this is a very important note here. The EBITDA for Walmart was less in 2023 than it was in 2012. So profits have not gone up. They haven't even stayed flat. They've gone down, which is stunning. So yeah, as I say, it's exponential times. You need to be in exponential assets. Things like crypto, things like Tesla, things like AI. This is where the action is going to be, ladies and gentlemen, for the umpteenth time. If you're holding the Oracles or the Walmarts of over the last quarter of a century, you lost. And I'm sorry about that, grief tidings. Whoa, we have some type of graphical problem here. We are today, this should be 4 images. I don't know what happened. Let me see if I can pull it up because they're beautiful images by sharing my screen. There was something else that got a little bit messed up too. So bear with me 1 second. I'm going to pop this so you can see animals. Too important not to share. So these are the monarch butterflies and cocoons and all these cool little things. And let me pop my camera back on. Now you get an idea for what I was talking about with these beautiful images that somehow didn't show up. But blow it up again. This one goes out to our Patreon member, Recluse Men. Unfortunately, the monarchs are a very endangered species, just like the bees, and they're one of our most valuable pollinators on the planet. And their extinction and decline will directly impact the human food systems, as plants require pollinators to reproduce. So boycott all Monsanto products and do everything you can to plant bushes like butterfly bushes. We've got 4 huge ones here to help the butterflies. So Recluse Man, thank you. And if you want to amplify intelligence, you know where to subscribe. You will not find this level of knowledge anywhere on the internet, especially the way we pack knowledge together fast from the greatest minds in the business. Everybody here as well. So I'm going to pop up some questions, and thank you to the mods in the chat for being here with us on a Sunday. Really appreciate you all. Let me see. RustyBot. It's not what it looks like. Oh, I miss that, but thank you. For the animals from Kyle Villas, appreciate you, and Adam Q as well. Thank you for all you do. This is from Mr. Mo, Kietel Mo. I have 70% ETH and 10% Bitcoin, and the rest spread around. Do you think I'm, holding too much ETH? I definitely do. I think I always look at kind of risk. I think, obviously, when you look at crypto, the least risky is Bitcoin. Allocate accordingly. And then after that, the least risky after that is Ethereum. I personally think it's better to be kind of a 60% to 70% Bitcoin, and then say 30 to 40% altcoins, of which Ethereum should be a large position for sure, but not 70%. So I definitely get more Bitcoin, try to get to that whole coin target that we stress here, and then spread the other 30 to 40% across ETH plus a winning alt, whatever you decide it could be, whatever is the cheapest at the time. Matt C. One of the advantages of crypto versus stocks is the ability to purchase fractional shares down to a few dollars. Do you think stocks will ever be traded as fractional shares, or is that impossible for legal and financial reasons? I absolutely do believe it, Matt C. Great question. Everything will be tokenized, including stocks. And in fact, if you look at the work that some of the big traditional TradFi market players are doing, they know this is happening. So you'll be able to buy a tokenized element of, say, a Berkshire Hathaway stock on a decentralized, some type of exchange, blockchain platform in the very near future. I don't know if it's going to be 2 years from now or 3 years, 4 years, but definitely it will. But the problem is the legal system needs to come up to date to allow for that type of activity to happen as well. Let me see. Jim Manley, are you familiar with Lilium, an eVTOL German company? Elon spoke of it on Joe Rogan Show. I'm very familiar with eVTOL companies. They are fascinating. In fact, I nearly became an investor in one a few years ago. But I know that Google founders are making big investments in them as well. And I do believe there is a space for them for short type hops. Like if you imagine you want to go from downtown Manhattan to somewhere close but avoid traffic for a limited number of passengers, it can definitely work. But I have not looked at that. I do know that the space is going to be ruthlessly competitive. It won't be profitable for a long time because you've got to use the best of the best batteries. It's all about weight. You need extreme power. 90% of the power is burnt when you take off with these eVTOLs. Think of them as, for those who don't know, they're battery-powered helicopters. But yeah, when the time comes, nobody has better batteries than Tesla, and if it's possible, they might go down that path too. But I also believe that an eVTOL, in order to save weight of a passenger, it needs to be autonomous. So it needs to be able to fly by itself without a pilot. And I'm not sure if the technology is kind of there. I know it is kind of there, but not fully for flying devices, or at least to be approved by things like the FAA. So Jim Manley will be on it, monitor for you to see if there's any options worthwhile with the eVTOLs. But again, in the market conditions we have, everybody, I like companies with very low debt that make a lot of profit and have a lot of growth. That's it. So anything else I'm not touching. Remember the 2% I spent talking about at the beginning? So critical. And thank you as well for your super stickers. Andy, KN, Nick M, The Great Escape, Z, Jim Manley, Dog1, Mr. Shake, Silicon Valley Stoic, AC1, Jeff Hammer, Sigma 103, Dave Spadafora. And remember, tomorrow DCA is on my channel, 7:30 a.m. Pacific. That's 10:30 a.m. Eastern US time and 4:30 Central European time. Thank you all, everybody. Happy Sunday. And yes, exactly. Fit Pola. Boycott Monsanto. You're dead right. Thank you all for coming. Go take care of yourselves. I can't believe we did all that in 45 minutes. Wow. That was a lot. See you all later. I hope you let me know if you like me doing a lot of questions fast or deeper dives on less questions. Thank you all. See you.